Here's a scenario I see all the time with Bay Area tech clients. Someone has spent 5, 6, 7 years accumulating company stock, RSUs vesting every quarter, some held, some sold. And now they've got $500,000, maybe more, sitting in a single stock. And they know they should diversify, they've known for a while. But every time they think about selling, they run the numbers, see the tax bill, and put it off for another quarter. If that sounds familiar, this video is for you. Because there are real strategies for reducing concentrated stock exposure without triggering the full tax bill all at once. And today I'm going to walk you through 5 of them and give you a framework for figuring out which one applies to your situation. Let's get into it. Before we talk strategy, I want to reframe the way most people think about the tax bill on concentrated stock. The concern is usually this: if I sell, I'll owe capital gains tax. In California, for a high earner, that's federal long-term gains at 20%, plus the net investment income tax at 3.8%, plus California's rate of 9.3%. Combined, you're looking at around 33% on long-term gains. On a $500,000 position with a low-cost basis, that might be $150,000 or more. That feels painful, but here's the reframe. Paying taxes on a gain means you have it. The alternative to paying $150,000 in taxes on a $500,000 position isn't keeping 500 grand. It's keeping $350,000 in a diversified portfolio instead of $500,000 in a single stock. Whether that trade-off makes sense depends on your specific situation, but it should be a deliberate decision based on the full picture, not a default driven by tax avoidance. With that in mind, here are the 5 strategies. Strategy 1 is the simplest and the most commonly appropriate: systematic selling over time. Sell a portion of your position each year, spread the tax bill across multiple years, and reinvest the proceeds in a diversified portfolio. This works for a few reasons. Spreading the sales over multiple years keeps your annual capital gains from spiking into a higher bracket in any single year. It also gives you flexibility. If your income is lower in a particular year, maybe you changed jobs or took a leave, you can sell more that year to take advantage of the lower rate environment. For most tech employees, systematic selling is the foundation. Other strategies layer on top of it. The main limitation is time. If you want to diversify meaningfully and your position is large, doing it over 5 to 10 years means carrying concentration risk for a long time. That's when the other strategies start to matter more. Strategy 2 is exchange funds. This one is less well known, so let me explain how it works. An exchange fund is a private investment partnership. You contribute your appreciated stock to the fund. Other investors contribute their appreciated stock. The fund holds a diversified portfolio of all the contributed shares. After a minimum holding period, typically 7 years, you can redeem your interest and receive a basket of diversified stocks rather than your original concentrated position. Here's the key. Contributing to the fund is not a taxable event. Your original cost basis carries over. So you've achieved diversification without triggering a tax bill. The tax is deferred, not eliminated, but over 7 or more years, that deferral has real value. The constraints are significant. These funds typically require minimum contributions of $1 million or more. The 7-year lockup is real. You can't access your capital during that period. And the fees are higher than a standard index fund. For the right situation, a large, highly appreciated position and a long time horizon, exchange funds are a genuinely powerful tool. For most tech employees with positions under $1 million, the constraints usually outweigh the benefit. Strategy 3 is charitable giving through a donor-advised fund, or DAF. If charitable giving is already part of your financial life, a DAF is one of the most tax-efficient tools available for reducing a concentrated position. Here's how it works. You contribute appreciated shares directly to the DAF. You get an immediate charitable deduction for the full fair market value of the share. The DAF sells the shares without triggering capital gains taxes because it's a tax-exempt entity. And then you can grant the proceeds to charities of your choice over time on your own schedule. The tax benefit is significant. You've removed the shares from your portfolio, avoided the capital gains tax, and received a deduction for the full value. At Bay Area income levels, that deduction is worth 42 to 45 cents on the dollar. The obvious limitation is that the money is permanently committed to charitable purposes. If you're already charitably inclined, this isn't really a limitation. It's just a more efficient way to do what you were going to do anyway. If you're not, it's a different conversation. There's a more sophisticated variant called a charitable remainder trust that provides ongoing income as well as the charitable benefit. But that's a more complex structure and worth its own dedicated discussion. Strategy 4 is opportunity zone investments. If you've already decided to sell a large concentrated position and you're looking for ways to manage the resulting tax bill, investing the proceeds in a qualified opportunity zone fund within 180 days of the sale allows you to defer the original gain and potentially reduce it. A few important caveats here. The tax benefit kicks in after the sale, not instead of it. So this strategy is most relevant when you've already triggered a large capital gain and need somewhere to put the proceeds. The investment universe varies significantly in quality. Opportunity zone funds invest in real estate and businesses in designated low-income communities. The underlying investment needs to stand on its own merits, independent of the tax benefit. Don't let the tax tail wag the investment dog. Strategy 5 is tax loss harvesting against the gain. Capital losses offset capital gains dollar for dollar. If you have positions elsewhere in your portfolio sitting at a loss, harvesting those losses in the same year as a large stock sale reduces your net taxable gain. Think of this less as a standalone strategy and more as a coordination layer. Before you execute any large sale of concentrated stock, review your full portfolio for harvestable losses. At Bay Area marginal rates, the savings can be meaningful. So with 5 strategies on the table, how do you choose? Here's the framework I use with clients. Start with systematic selling as your default. It's simple, flexible, and doesn't require minimum thresholds or lockup periods. For most tech employees, this is the right foundation. Layer in tax loss harvesting regardless of which other strategy you use. It costs nothing and reduces your net tax bill. It should always be part of the conversation. Consider a DAF if charitable giving is already part of your plan. Contributing appreciated shares instead of cash is almost always more efficient. Consider opportunity zone investments if you've already sold and want to defer the gain, but only if the underlying investment makes sense on its own. Look at exchange funds if your position is above $1 million, highly appreciated, and you can tolerate a 7-year lock. And consider a charitable remainder trust if you have a very large position, charitable intent, and want ongoing income. Get proper legal and tax advice before going down that. The bottom line is this. Concentrated stock is not a problem without solution. It's a problem with several solutions, each with different trade-offs. The right one depends on your specific situation. What it's not is a reason to do nothing. Holding a concentrated position indefinitely because the tax bill feels too large is a choice, and it's often the most expensive one in the long run. If you've been putting off this conversation, that's exactly the kind of planning exercise worth doing before the decision gets made for you. If you want to talk through your specific situation, I'm happy to take a look. The link to schedule a call is in the description. And if you haven't subscribed to Vested yet, my weekly newsletter for Bay Area tech professionals, the link for that is down there too. I'll see you next week.